All right, we're going to talk about taxes now and how to record them. Now, tax laws are always changing, so um, what you have to understand the amount of tax has changed over the years as well. Now, or what it's even called has uh, changed, and we're talking about sales taxes. Now, prior to July 2010, okay, when a company sold a good or service, it had to charge taxes. Now, it still has to charge taxes. But prior to 2010, okay, we had a goods and services tax or GST and oops, sorry. Okay, it was 5%, and we also had a PST, so a provincial sales tax, and it was 8%. Okay, now after July, now before that, it was equal to total 15%, so the GST was 7. Okay, so the percentages are always changing. Okay, now after July 1st, okay, HST came into effect in Ontario. Now, HST was already in effect in the Maritimes and prior to 2010, but it came into effect in Ontario on July 1st. Now, it replaced the federal goods and services tax, the GST, and the provincial sales tax. So they basically were combined into a single tax. And HST stands for Harmonized Sales Tax. So what they did was they combined these two taxes. Now, prior to 2010, basically you were collecting money for the federal government and you were also collecting money or for the provincial government, right? Because you had to charge sales tax, right? After 2010, basically you are collecting the 13%, so a total of 13%, and you're going to have to send it to the federal government, and then the federal government will send it to the provinces. Prior to 2010, you had to send the GST portion to the federal government and the PST to the provincial government. So you had to send it to two different places. Now, basically, you're just sending it to the federal government, and they are divvying it up to the province. All right, now or provinces. Now, HST is applied to most goods and services, and I say most because some goods and services are not taxed. Now, we're not going to get into the the nuts and bolts of taxation. There's a whole course in university for in regards to taxation. So we're just going to scratch the surface. Now, at the end of each quarter or every 3 months, the HST that's collected or charged on our sales, we're going to take that and we're going to reduce it by any HST that we pay out or we pay on purchases. And then the difference is going to be remitted or sent to the Receiver General of Canada. So we're going to take what we collect in tax and we're going to subtract what we pay out in sales tax because we make purchases too as a business. All right, so let's look into that a little deeper. All right, so the taxes a business collects from selling goods and services are recorded in an account called HST charged on sales or HST payable. Now, it's a payable because when we collect taxes, that's not our money. We owe it to the government. So we're going to, no matter what we call it, HST charge on sales or HST payable, it's a liability account because we owe that money to the government. So it's going to have a credit balance. All right. So let's go through an example. Let's suppose that we're a gym and we sell a fitness membership for $300. How are we going to record this if we have to record the taxes as well? All right. So let's assume we're going to sell it for cash, right? So how much is the person going to pay us? They're not going to pay us $300 because they owe us $300 plus the HST, which is 13% of $300. So they're going to owe us, or they're going to pay us $339. So cash is going to be debited. Now you have to record the fact that revenue is going to be credited for $300, and then you have to record the fact that, you have to record the tax. So HST, we made a sale, so HST charged on sales is going to be the additional $39. Okay, so again, sold the membership. All right. Now, by comparison, a company is charged taxes when it purchases things. The money it pays out in taxes is going to be recorded in an account called HST paid on purchases, or HST recoverable. Now, the taxes it pays out in taxes, the money it pays out in taxes is going to be returned to the company by the government. So basically, it's going to reduce what the government, what the business owes the government. So again, we're going to take HST charged on sales. That's the money we're collecting from customers that we owe the government. And we're going to subtract what the company paid out in taxes. All right? Now, the taxes a company pays are HST recoverable or refundable. When it buys goods or services, is recorded in a separate account again. Okay? You can either use HST paid on purchases or HST recoverable, either one. Now, it's not an asset, it's not a liability, it's not owner's equity or drawings, it's not revenue, and it's not an expense account. It's a new type of account. It is a contra liability account. So a new type of account. And a contra account reduces another account. So a contra liability reduces a liability. Now, what liability will it reduce? So HST paid on purchases reduces HST charged on sales. Because HST charged on sales is what we owe the government. So what we're going to do is we're going to subtract what we owe the government, or we're going to subtract what the government owes us, HST paid on purchases, from what we owe the government. So it specifically reduces HST payable, or HST charged on sales. HST, charged on sales. Now, it's listed, it's a liability, but it has a debit balance. So HST paid on purchases, and that's the thing about liabilities, they have a balance opposite of what they are contra to. So a contra liability has a debit balance because a liability has a credit balance. So a contra liability will have a debit balance. Now it's listed in the liability section of the balance sheet. Okay, and again, it has a debit balance. So I'm going to scroll down a bit. So when we list it on a balance sheet, you're going to notice that these are all liabilities. HST paid on purchases, or HST recoverable or refundable, it's a contra liability. So it doesn't have a credit balance, it has a debit balance. So what we're going to do is we're going to list it with all the other credit balances, but we're going to put brackets around it, and we're going to subtract it from all the other credit balances. All right, now let's go through an example. So let's suppose we're still a gym and we purchase $100 worth of equipment on account. Now, again, assuming that we have 13% sales tax, okay? Equipment is going to be debited for 100, right? HST paid on purchases, or HST recoverable or refundable, is going to be debited for 13. And now I owe a grand total of $113. So accounts payable is going to be credited for 113. All right, so you are going to be recording journal entries that now involve tax or taxes.